As we've been reporting, U.S. initial jobless claims and GDP came in worse than forecast. For a look into the data, let's bring in Guy Lebas, Chief Fixed Income Strategist at Janney Montgomery Scott. Guy's ranked as one of Bloomberg's most accurate economic forecasters on GDP. He joins us now from Philadelphia. Guy, welcome back to Bottom Line. Always a pleasure to have you on.
Thanks, Mark.
Guy, today's numbers, do they suggest that the economy is still treading water at this point?
Well, I think really what they suggest is that the recovery is over. Well, what comes next? That's the big question. And what we see coming next is a return to an underlying trend. If you take a look at the trend of economic growth through the 90s into the 2000s, we had a lot of things going for us. First, of course, the tech boom, then, of course, the housing boom, and then government spending. But all three of these are off the table. So the question is, what's next for economic growth?
Okay, so Guy, when you say that the recovery is over, do you mean the phase of getting above water and now we can breathe, we're getting some air?
I think that's a fair way to put it, yes. The period of sort of faster economic growth in the wake of the recession is done for. And what we can expect going forward is what I would describe as kind of a steady state, but one that's a little bit slower, a little bit lower than we were used to over the course of the last several years. Again, because there's no one major engine of driving growth.
Guy, why is corporate America doing so well, but the economy as a whole still hasn't gained traction?
Well, I think there are a few things, and actually if you dig into the corporate profitability numbers that were released today with the GDP numbers, you can see a couple of trends. Number one of those is that foreign-related profits, as in profits from sales to overseas corporations, are much stronger than domestic ones. In fact, without those foreign sales, domestic profits would have actually declined by double-digit percentages, or rather total profits would have declined by double-digit percentages. So it's this foreign demand that's really pushing corporate profitability a little bit higher these days.
Well, consumers are getting hit from all sides. You know that. High unemployment, high gas prices, stagnant wages, depressed housing market. It's hard for them to be patient. Is there any room for optimism?
Well, there's room for optimism, but unfortunately the room for that optimism takes several years to be fully realized. We're not expecting job growth or jobs to return to pre-recession levels realistically until 2016.
Why so long?
Because of two things. Number one, job recoveries tend to be much slower than job downturns, and we've seen that. Even at a rate of 200,000 jobs per month, it's still going to take 5 years to get back to where we were pre-recession. The other issue is population growth. So that means you're sort of digging a deeper hole, even though the economy is adding jobs.
Guy, in the October to December period, consumer spending grew at a rate of about 4%. In the first 3 months of this year, the number was half that. How much of that's due to geopolitical events in the Middle East and North Africa?
A moderate degree. I'd say there's a bigger underlying trend going on, which is that consumers are no longer borrowing on their credit cards, what have you, to finance their spending. And as a result, the sort of core rate of consumer spending growth is really going to be limited to wage growth. And as we've seen, and as you mentioned a few minutes ago, the data indicates that wage growth has not been all that fast. So without the engine of additional borrowing and with wage growth relatively stagnant, the long-term trend to consumer spending growth is going to be fairly anemic. 2% is going to be as good as it gets.
Yeah, and Guy, it's interesting you point that out, because even those Americans who are fortunate enough to see a little bit of a rise in their wages, that gets taken out because of the rise in energy prices, particularly gasoline. If you drive your car to work, then you're getting hit. So what wage increase you got, it's right out the window.
Right. Net of inflation and net of gasoline prices, wage increases are pretty limited. One of the things about gas that's very challenging is consumers can't reduce their use of it in the short term. So if gas prices go up, the only choice is to cut back elsewhere. And I think that's what a lot of what we saw in the first quarter.
Guy, we did see strength, as we mentioned, in the business sector. Companies taking advantage of that one-year tax write-off on purchases like equipment and software to spend more money. Are they positioned for growth when the economy finally shows elements of sustained growth? And what happens when that tax write-off goes away?
Well, I think at this point, most corporations have actually squeezed out all the efficiency gains they can really gather from purchasing new capital equipment, from requiring employees to work harder and work longer. So realistically, there's not a lot of great position that firms are in to be able to take advantage of future economic growth. I think the optimal course for firms right now is to look for that foreign demand, which still seems to be running pretty strong these days.
Guy, we have about 30 seconds. The market's also keeping an eye on that European debt crisis, and the latest concern is Greece. This week, the government and the opposition party failed to come up with an agreement on how to deal with the country's finances. Is Wall Street's reaction about what you expected at this point?
Well, there are some deep concerns over Greece, but they actually have nothing to do with Greece itself. They refer to the risk that if Greece fails, more dominoes are going to topple. Notably, Greek banks may very well be nationalized, and that could cause greater strains across the European banking system. It's something we're very cognizant of and increasingly worried about.
Guy Lebas, Janney Montgomery Scott, joining us from Philadelphia. Guy, it's always a pleasure. Thanks so much.
Thank you, Mark.